Coming up, throughout the recent performative morning Olympics and following this week's mini-budget, the UK financial markets reflect grave concerns about post-Brexit Britain's economic outlook. The pound sterling is at its lowest against the dollar in nearly 40 years. It's tumbled against the euro too. And UK share prices continue to decline, along with government bonds making the cost of borrowing that much higher. An analysis in the Financial Times last week found that, on present trends, the average Slovenian household will be better off than its British counterpart by 2024, and the average Polish family will move ahead before the end of this decade. Thank you, Brexit. Income inequality in Britain is now so enormous that international economists are classing the UK as a poor country with some very rich people. A lot of them, I have to say, are in the government. Liz Truss has said it's all about economic growth and that she's not interested in the redistribution of wealth. Her tax cuts announced this week will increase the imbalance in favour of the mega-rich with the abolition of the top-rate 45% tax rate, so things can only get worse. Stay tuned. If you enjoy watching my videos, please give this one a like and spread the word by sharing a link on your favoured social media platforms. If you subscribe, you can also hit the bell icon to be notified of each new video I release. With rising wealth inequality, falling standards of living, a stock market in decline, sterling crashing, and the national debt reaching eye-watering heights, the big news this week was that alongside their tax cuts favouring the very richest in society, the Treasury is refusing to publish the forecast of the UK's economic outlook from the Independent Office for Budget Responsibility, the OBR. This is absolutely scandalous and proof that the Truss government are trying to hide the economic impact of their tax cuts and the £150 billion of public money handed out to the energy companies to protect their extortionate windfall profits. Why won't they publish? The only possible explanation is that the markets won't like what the OBR has to say. But by refusing to publish, it's almost worse, with the financial markets tanking as I record this video just after the mini-budget. The markets know too well that the reversal of the rise in national insurance and the scrapping of the increase in corporation tax is likely to amount to another £30 billion in lost taxes, and all the predictions are that the UK is facing a lengthy recession which will lead to a further reduction in tax revenues. This implies a vast amount of government borrowing, and along with the high inflation rates not seen since the last Tory government, the UK's economic situation looks increasingly dire under Truss. And that's even before we come on to the ramifications of a Brexit that is nowhere near done, with import controls still not implemented and a Northern Ireland protocol that Truss and her team are threatening to rip up. The trading relationship with the EU, already damaged beyond repair, could see a further turn for the worse as the UK reneges on international law and the terms of the Brexit withdrawal agreement. This is a huge concern for investors, and as a result, British assets have all been marked down on the global markets. Government bonds, share prices, and the pound sterling have all declined simultaneously in recent weeks, and that combination will mean soaring borrowing costs and enduring inflation for the rest of Truss's premiership. We're told by our friends on the right of British politics to give Truss a chance, despite the fact that her record as a cabinet minister has been one of failure, embarrassment and incompetence. But the global financial markets in any case have already made up their mind. They believe her policies will do further harm to the investment environment for the UK. And look, I get it. What with the pandemic and the war in Ukraine, the world's markets have had a tough year or more. But the weakness of British assets still stands out as particularly bad. The pound has tumbled 16% against the US dollar this year, even before the mini-budget, and is now at its lowest level since 1985. The pound has also lost 4% against the euro this year alone. The FTSE 100 stock index hasn't done great, but does reflect the global markets, as most of the 100 companies making up the index are multinational companies. But if you look at the FTSE 250, which has a much higher proportion of UK-focused companies, well, the FTSE 250 has dropped by 20% this year alone. And falling bond prices as well means that government borrowing is now the most expensive it's been in 11 years. This is the financial context for the massive inflation and deepening cost of living crisis after 12 years of Tory government. And it's set to get much, much worse. The Truss package to cap energy bills for at least 6 months is estimated to cost roughly £150 billion. And with her ruling out windfall taxes on extortionate windfall profits, that cost will have to be met by further government borrowing at a time when borrowing is way more expensive than it has been for years. To put this in perspective, economists are saying that this policy is likely to turn out to be the biggest single fiscal announcement in peacetime in the history of the UK. It's a staggering quantity of money, yet the government is refusing to put its own cost estimates into the public domain, while also refusing to publish that OBR forecast for the overall economic outlook for the UK. Nothing to see here then. Move along. But even that £150 billion thrown at the multinational energy companies may be dwarfed in the long term by all the tax cuts that have been announced in the mini-budget. And remember, at the same time as giving billions in handouts to the multinationals and cutting taxes that will disproportionately benefit the wealthiest in society, Truss's government will need to find more money for public services, for example, the NHS and pay rises to teachers, because inflation has eroded the value of previously announced spending plans. It's an utter mess. And Sue Nofke, head of UK equities at Schroders, has no words of comfort. She says that although British stocks have suffered since Brexit, further uncertainty and worries about economic growth and messy politics under Truss have made them one of the first to be jettisoned as investors move away from stocks. And it's not just the London stock market that's suffering. Bets against the pound are increasing since that mini-budget. Analysts in the United States have remarked that sterling is starting to look like a currency from a developing country due to its vulnerability to a further steep decline caused by Britain's widening current account deficit. In the first quarter of this year, the deficit was a record 8.3% of gross domestic product. Mark Carney, the former governor of the Bank of England, says that because of Britain's budget and current account deficits since Brexit, it needs to borrow more and is therefore increasingly reliant on what he has called the kindness of strangers. By kindness of strangers, what Carney really means is that Britain relies on investor confidence in the British economy. So much for taking back control. Shreyas Gopal is a strategist at Deutsche Bank who carried out an analysis of the British economy just before Truss became Prime Minister. He warned that a very large but untargeted spending package, exactly like the one announced by Truss 2 days later, risked exacerbating investors' fears about the sustainability of the national debt. If investor confidence erodes further, this dynamic could become a self-fulfilling balance of payments crisis, whereby foreigners would refuse to fund the UK's external deficit. But not everyone agrees that the biggest risk to the currency is from this balance of payments crisis. Analysts at Barclays, for example, say that the real risk to the currency is actually the deterioration of British trade with its biggest trading partner, the European Union. While Richard Ports, Professor of Economics at London Business School, says it's a range of things that makes Britain's economic background so very disturbing. He talks about not just the wide current account deficit, but also labour unrest and the Truss government's decision to remove the top civil servant in the Treasury, and the likely recession as all being major threats. To quote Professor Ports, "The Governor of the Bank of England is in a very weak political position. The Treasury is headless. Where are the grown-ups?" I think that's a question even most Tory MPs are currently asking. I always find it interesting to see what the non-partisan and transparently funded Institute for Fiscal Studies have to say on any economic issue, and Director Paul Johnson is extremely concerned, of course. Quote, "What worries me is that there will be a dash for growth, cutting taxes and increasing spending and so on, and that might look good for a year before the election, but it's deeply unsustainable and potentially long-term damaging." The Bank of England believes that the UK economy has already tipped into recession this quarter, and that the economy will shrink by a further 1.5% next year. And talking of the Bank of England, this week saw a 0.5% rise in interest rates to 2.25, the highest in 17 years. According to Richard Murphy, Professor of Accounting Practice at Sheffield University, a person on an average standard variable rate mortgage will, after this interest rate rise, have seen their annual mortgage cost increase by more than £3,000 since rate rises started last December. This may double to £6,000 of additional costs for the average mortgage payer by next May, based on current forecasts. And just let that sink in. £6,000 a year for the average mortgage holder. How will they be able to afford that? Professor Murphy says the scale of the financial crisis that is going to evolve over the weeks and months to come as a result of this callous consequence of the Bank of England's decision is almost unimaginable. If we thought the energy crisis was bad, things are going to get very much worse for millions very soon. He goes on to say, there is only one answer to this. The Chancellor has to tell the Bank of England that it must reverse this policy and cut interest rates now. If he won't, then this crisis is his responsibility, and it's terrifying. Meanwhile, this is our Chancellor, Kwasi Kwarteng, having a merry old time at the Queen's funeral. And what's going on? Has he tucked into Michael Gove's stash, do you think? Or is he suffering a psychotic episode? Or does he just find funerals very amusing? I'm not sure, but with this man as Chancellor and Truss as his boss, we can expect lower growth, higher inflation, ballooning public debt, soaring mortgage repayments, which will also directly lead to buy-to-let landlords increasing rent for tenants, plus ever-increasing balance of payments deficits, increased industrial action, ever-worsening relations with the EU, increased pollution of our waterways and air, with the reintroduction of fracking, and cuts to public sector services including the NHS and education. All the time that Truss is Prime Minister, the rich will be getting richer and the poor will be getting poorer, because Trussonomics is based on the greedy, obscene and discredited dogma of trickle-down economics. Given the global energy crisis, plus the specific and ongoing economic problems for the UK caused by Brexit, I don't believe for 1 second that this government will offer realistic solutions anytime soon.